Hi everyone, welcome to another honeystocks.com stock market outlook video, which will be going out on Saturday the 11th of February 2023. Now, before I switch over to my screen share and walk you through all of the charts and the data that I know most of you tune in for, I just want to take the opportunity to thank everybody who has reached out over the last month with some nice encouragement and nice words. I do appreciate it. Unfortunately, I don't have the time to upload these analysis videos every week as I did a few years ago. I'm just way too busy with my clients, unfortunately, but I do appreciate. This week what I'm going to be doing is digging into a lot of the charts to give some context around has the market bottomed, or is the collapse that everybody's expecting on the near horizon. So I'll go through a deep dive with some individual names and of course some ETFs from our chart book as well. For disclosure, some of the charts communicated, myself or our clients may hold some positions in some of the names mentioned or recently exited some high performing positions as well. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is incredibly important for the field in which I work. And although I do use technical analysis with fundamentals, I'm definitely not a short-term trader. There's plenty of gurus out there on social media and YouTube, etc. But I think you'll probably find that there's a big difference between my work and a lot of the nonsense that's posted across various social media streams. I'm in it really for trend following principles and longer term structural trends in the market, and of course logical turning points and pivot levels within the market as well. So like I said, I will try to give a lot more context as to what we're currently seeing in the current environment, and I think you'll probably get a lot of value from those charts. Just to give myself a little bit of credibility, some of my recent time-stamped work, I think most of the last 12 months I've been pretty much spot on. Got the crash 1 year ago now, the rotation from growth into value for 2022, the bear market rally in June, the exact top in August, the exact top in the US dollar, the market bottom in October, the bottom in bonds, the bottom in China, and most recently as well, at the start of the year, I made a bullish call on a rotation back into tech, which is exactly what we've seen. And of course, you could go all the way back to 2020, where I also got our clients defensive ahead of that crash as well. So as you can see, I do have a track record of being mostly correct, and I'm told my work is among the very best in the world. So if you do find value from this, please do like, share and subscribe on YouTube. And if you do find value from my work, feel free to follow me on Twitter as well. Very important disclaimer, please pause the video, make sure you are comfortable with that before going on any further, and let's dive into some charts. So it makes a lot of sense to start with one of the biggest economic charts that I have. I am aware that the yield curve is currently inverted, but I also know that it can take quite some time for a recession to actually play out. So whilst I am aware of the yield curve, my work is still focused on the individual areas of the market that are trending, because I don't think you can make investment decisions based on something that can potentially happen 6 months, 12 months further down the line. That just doesn't make a lot of sense to me. But we all know that Michael Burry has been putting out some content and some of his tweets over the course of the last few weeks, telling everybody to sell, and that this time it's different. Now, Michael Burry is looking at the market with extreme bearish targets. Hopefully this chart can illustrate just really what he's seeing here, that the market has the potential to ultimately undercut the previous crash, which of course would give us a target around 2,400. Now, he's essentially looking at the textbooks, which tell us that we still have to experience for a true market bottom, for capitulation and despair. Now, I think the first thing to say is I absolutely do not rule that possibility out, but my work at the moment is much more focused, like I said, on the more of a near-term outlook. I'm looking at it weeks to months. I'm not looking at it 12 months out. I'm not looking 2 years down the line. For me, the charts will tell me to get defensive well in advance of these types of scenarios. So this is a one chart snapshot of what we're seeing in the NYSE composite, the Russell 2000, and of course the S&P 500. And what we can see just from a quick snapshot is we are hovering around these key technical levels in each of these key areas of the market. Now, for me, my work is predominantly focused on market direction at the moment, and for me, the US dollar is the absolute key to everything that we can expect in the near term. Now, this is the chart for the US dollar index. Now, the US dollar index is of course incredibly important because throughout this rip in the US dollar, of course, stocks were coming under massive amounts of pressure. Now, it's not any surprise that since October, the US dollar index has been going down, and of course, what has that what's that done for stocks? Stocks have been on the rise since then. I've done a very good job of keeping on top of the US dollar index. Some of you who follow me on Twitter will now know that I put out a tweet that got me a lot of attention from a lot of professionals asking me what I was seeing. So what I am going to do this week is just run through the current state of play with the US dollar, because the US dollar is going to give us the direction of the market and what happens at these key levels. This is of course the longer term chart. I think if the US dollar index breaks out above these levels again, I think, given what we know, that when the US dollar is rising, then of course we can expect stocks to come under a little bit of pressure. But we need to dig into the US dollar index a little bit more, in my opinion. The weightings of the US dollar are of course heavily weighted towards the euro. So if we want to understand the direction of the US dollar index, we need to dig in to what's actually going on with the euro. Now, the US dollar index is incredibly important because it has a very strong correlation with the volatility index. We all hopefully understand that when the VIX is ripping higher, that's in an environment again where stocks are coming under pressure. So if the US dollar index is going to catch a bid, then we could expect quite reasonably that the VIX is going to be spiking in that environment. So what is the euro currently doing? Well, the euro is currently pushing against levels that I want to pay attention to. The 50-day simple moving average is something that we learn technical analysis kindergarten. And the question is, if we start to break lower with the euro, again, how will that impact the US dollar index? And given it's basically a 60% weighting, then that's information that I want to pay attention to. This chart probably shows it a little bit better. This clearly shows a massive inverse correlation with the euro dollar and the US dollar index. So they essentially move in opposite directions, and if the US dollar index is rising, that's an environment where the the euro dollar is moving lower as well. Now, I've had a lot of questions over the course of the last week asking me why stocks are now only starting to come under pressure. It is a combination of factors. The dollar is a big factor here, but also the 10-year Treasury note yield. Now, the 10-year Treasury note yield has bounced and rebounded quite well with a lot of conviction from its 200-day simple moving average. For those of you that follow me and have done for a long period of time, you'll know that for me to get super bullish on pretty much everything, we'd be looking for a breakdown lower in the 10-year Treasury note yield, and that's just not what we've seen. Over the course of the last week, we have started to see signs of cracks in the market. A lot of the recent high flyers, which I will be going over in just a few moments, a lot of the individual stocks that have already ripped 50 to 100% are again starting to come under a little bit of pressure there, and that's information that I of course want to pay attention to. Now, one of the big components of getting defensive ahead of big bearish moves is something that I specifically look for, and it's really just the failed move. Now, I'm not going to go back and use magical hindsight indicators here. All of my work is time stamped. This is all information that I have called in real time, but I think for the purposes of this presentation, I think it makes a lot of sense to just show you visually why I like to pay attention to failed moves. This is back in 2018. We also have the COVID crash in 2020, and of course, if we want to go forward to the present day, we can of course have a look and see what's been happening throughout the course of the last 12 months. It's really just been one failed move after another with these violent rallies. So again, I'm asking the question here, are we looking at another potential failed move? So I think when we start to put the weight of the evidence approach together, we look at the US dollar index, we look at the 10-year Treasury note yield, we look at the euro, and we look at the charts for the S&P 500, it really just tells me that this is an environment where it's not really a massively risk on for new positions. That's really the way that I am looking at the current market environment with the moves that we've seen over the course of the last week. We can of course look at the Russell 2000. Again, if we start to break below these levels in the Russell 2000, then again, it's really the Russell 2000 is a really good gauge of market risk appetite. And I think if the Russell 2000 starts to break below these levels, coupled with the S&P 500 putting in a potential failed move, then again, that just tells me to get incredibly cautious. We already know that the Dow is struggling to get above key levels here. We've been on top of the failed breakdown in the Dow, the value areas of the market over the course of the last 6 months have been the place to be. It's only recently that we've had the rotation into technology that I've already highlighted. We've got the triple Qs, Fibonacci retracement levels coming into play here, really why we've seen stocks or tech names, mega cap tech names stall out a little bit over the course of the last week, but we are above its 40-week simple moving average. But I think at the moment, to get meaningfully long on new tech positions, we probably need a meaningful pullback or a breakout above this $314 level. The performance in some of the tech names since the start of the year, if you look at Tesla's up 80%, Nvidia 47%, Meta up 40%. A lot of these names have made 12 months worth of gains in a good year in the space of 6 weeks. So common sense tells us that something has to give. And our message to our clients and to our members over the course of the last week has really been about risk management, highlighting levels in some high flyers that I'm about to go over in just a few seconds, to really start to think about managing risk and maybe taking something off the table given the environment that we find ourselves in with the US dollar charts, etc. So I'm going to get into around 15 to 20 individual names that I think you can add to your watch lists with very specific levels and risk management levels. But if you are still here, it tells me that you're getting a lot of value from my work. So please do hit the like button. It would mean the world to me. Like I said at the start, feel free to let me know in the comments if you agree, you disagree, how do you see things playing out, what areas of the market are you more interested in. But let's start off with Tesla. Now, one thing I want to just say is I don't like it when analysts walk through with the magical hindsight indicator. As you all know, I don't use the hindsight indicator. Any other high conviction ideas I have put onto the chart just so that you can see that I have made these calls in real time. But Tesla is one of those charts that it's a different breed of stock. That's really the message I want to get out here. I would never advocate shorting Tesla. I think if you short Tesla, you're really just opening yourself up to having your face ripped off. So I think if Tesla can get above that $200 level, I think there's a logical upside target there with another 50% upside. But I am expecting a little bit of digestion of gains here, maybe a little bit of sideways consolidation with hopefully before another leg higher. But again, the charts that I have to communicate are really going to come down to what happens with the dollar and the euro and the 10-year note over the course of the next couple of weeks. We could absolutely find ourselves in an environment where these stocks are collapsing. So, like I said, that's where I add in risk management levels as well. Now, Microsoft, a lot of attention, of course, with the Chat AI. It has been consolidating between its 40-week and its 200-week simple moving average. It does look like it's potentially putting in a breakout above its 40-week, but again, we'll need to see how things play out with the broader market, but it does look quite constructive at the moment for a stock like Microsoft. Now, Apple, textbook rebound from its AV/WAP levels. We're now looking at the 160 level. I think if it can get above 160, then I think we start to move towards testing all-time highs around that 185. Berkshire Hathaway, it's not all about technology names. I think above 320, I think makes a lot of sense. We've of course got Meta, which has had a massive move over the course of the last month. Again, this is a high conviction idea that went out to our clients and members with instructions last week to start managing risk in case we start to pull back and fill this gap around 155. As we can see at the moment, it is being recorded on Friday and we are starting to see Meta pull back a little bit here. So ultimately for me, it's thank you very much, Mr. Meta. Move on to the next one, wait for a big pullback, or again, wait for a further breakout there. Google had one of the most monumental car crashes I think probably we've seen in recent years. That their presentation wiped tens of billions of dollars off their share value this week. For me, we're waiting on a close above 106 on the weekly chart. Again, that's a 40-week simple moving average coming into play here. Ultimately, it is Google. I would also consider buying it again if it was to get back to this $85 level. But as it stands at the moment, I don't see any kind of risk to reward proposition with Google at the moment. I think it needs to get above 106 or it needs to pull back to that $85 level for, again, more of a swing style trade. We've got Block Inc. I was about to call it Square. Again, I think we're looking at this above $93, $94 or a potential pullback to 50. Again, I don't get into why stocks move up or down. For me, it's really just about risk to reward propositions. I don't really see any risk to reward proposition here. I think this is, of course, a very logical target level for Block Inc. But for me, looking at this to pull back to around 50 or break out above 93, 94. Amazon has had a lot of attention. I've had a lot of private messages on this one over the course of the last few weeks. Massively negative reaction to earnings. Again, we put this to our clients as a potential play running into earnings. It did exactly as expected, but it has run into its 40-week simple moving average, unfortunately. So again, we're looking at this as a potential pullback opportunity or a breakout above that 110 level. Semiconductors get, of course, a lot of attention. Looks like it's potentially trying to break out above technical levels, support resistance levels, whatever you want to call it. But I think if we are above that level around 250, I think it's probably a risk-on environment for semiconductors. Nvidia has been one of our plays. Again, it's more about risk management at the moment rather than adding to new positions. But it is above its AV/WAP levels from its all-time highs. It's broken out of chart pattern, if chart patterns are your thing. So again, we are managing risk on this one and hope to see this continue to move higher. Teradyne has been another one of our picks on this breakout here. Again, we're pulling back at the moment. So again, really going back to what I was saying, a lot of these charts will come down to what happens with the US dollar over the course of the next week. We also have KWeb. Now, we are bearish on China. I did actually post this chart to Twitter last week. I had some active pushback on it from some animated individuals, but ultimately, you know, the chart for me just tells me everything I need to know. I've done a good job of explaining why I look for failed moves, and ultimately the thesis on a bearish China looks to be currently playing out in the short term, but again, there's a lot of headline risk that comes with it. We made the capitulation call twice last year on China. So again, when we have areas of the market and ETFs that move 100% in the space of a few months, that's never going to continue forever. So again, we are bearish Chinese internet at the moment. We've got XLF above 36.50. I think financials might make a lot of sense, but this is one area of the market that I am really interested in at the moment, which is the energy and oil markets. Of course, energy was the play of last year. I think if we start to reclaim these levels and we start to see Brent oil move above $87, $88, then again, you're probably going to find that that's an environment where, you know, $75 billion share buybacks and names like Chevron probably start to come into play a little bit. This is one of our energy picks, Chevron. We've also got ExxonMobil as well, which has been another high conviction play, which is up 4 or 5% at the moment, and looks to be potentially breaking out again. So we'll ultimately see how things play out there. But if you have had some value from my work, again, please do hit the like and subscribe button, and feel free, if you have social media followers, to share it with your social media followers. It'd be much appreciated. But if you have just stumbled across my work for the first time, feel free to go and check out our website at honeystocks.com. We provide memberships for access to all of our premium content, which includes access to our premium weekend analysis, our midweek halftime analysis, which is sent out every Wednesday, access to all of our high conviction investment ideas, which I will show you exactly what that looks like in just a second. We provide access to a wonderful investing community full of traders, professionals, money managers. We provide access to my chart book, which covers stocks, ETFs and commodities, and also maybe if you're somebody that is in the process of adopting technical analysis and charting, I also include complete access to our technical analysis program, which I'm told is very, very good. I used to charge a lot of money for it, but now I just include it as part of all of our membership options. But just to quickly show you what our high conviction ideas look like, this is our idea that went out for Meta. Again, it's been an unbelievable performer. Tesla, again, unbelievable performer. Netflix has been brilliant. Newmont Corp was brilliant. ExxonMobil, again, done very, very well. And ELF, again, another massive high performer. But I think my work is a good fit for anyone if you have a mid-term approach, weeks to months. My work is suitable for professionals, money managers, retail investors. I think if you are someone who is perhaps a little bit too busy with work, family, maybe you're sick of hunting around social media for lots of ideas, maybe you just want to have access to a professional second opinion, maybe you want to get away from day trading, whatever your deal is, I think that's really generally who my work is a good fit for. But I'm very, very unique in what I do, because with all of our high conviction ideas, I also log on our website every single high conviction idea that's ever gone out to our clients and members. So feel free to go and check that out. Make sure the types of stocks that we like to recommend are the types of stocks that you like to buy. We don't recommend penny stocks. We don't. It's not any pump and dump schemes or anything like that. We're in it for longer term structural trends in the market, and I have logged every single idea that's ever gone out to our members over the course of the last 5 years. So feel free to go and check that out. But if you have stuck around to the bitter end here, thank you very, very much for watching, and perhaps we can welcome you soon. Thanks very much.